Hi, welcome back to another Econ podcast with Mr. Hagen. And on this podcast, we're going to continue to talk about investing. And before we do, I just want to say this video is not designed to give investment advice. It's for the purpose of education only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so what we're going to do in this video is we're going to do some practice problems based on some of the calculations we were doing in a previous video. So in the previous video, we talked about firm foundation calculations and using PE ratios, PD multiples, and yields to try to issue buy and sell signals. And again, this is not perfect. This is not like some guaranteed way that you're going to make money. This is one theory of the stock market. So I just want to be super clear. This is not investment advice. This is one theory of how to invest. So let's apply this theory to a set of practice problems. So first practice problem is some company X, and I give the following information. Their earnings per share is $3.75. Their dividends per share is $5, and the share price is 75. Now, first, one thing that might come to mind is you might say, how's this company paying out more dividends than what they're bringing in earnings, than what their earnings are, and that would be possible. The company could be paying. Some companies, even if they're losing money, they might continue to make dividend payments out of any savings that they have, things like that. They want their shareholders to be confident in the company, so even during bad times, they continue to make their dividend payments. So that is possible, just for anybody who kind of wondered why the dividends were greater than the earnings. Either way, that's not the point of this. The point of this is to do a practice problem. And so what you might want to do is pause the video right now and calculate your P ratio, your PD multiple, and yield, and then issue a buy or sell signal based on the firm foundation idea. So I'll if you want to pause it, go ahead and try it. And now I'm going to go through the calculation myself. So here we go. The yield is calculated by taking the dividend per share, which in this case is 5, divided by the price per share, which in this case was $75 per share if you want to buy a share of the company, and multiply that by 100. So we went out and we got this information about company X. I'll show you where to get that information later on. But we got this information about company X, and then we do these calculations. And so we would do 5 divided by 75 times 100, and that gives a yield of 6.6%. So that would give me a yield of 6.6%, really 6.6 repeating, 6.7, 6.67, whatever. That's your yield. The PE ratio. The PE ratio would be the price per share, which was 75, divided by the earnings per share, which is $3.75. This is the PE ratio. And so that would be 75 divided by 3.75. So that equals 20. That's the PE ratio. And then finally, the last would be the PD multiple. The PD multiple. And the PD multiple would be the price of the share, which is $75, all divided by the dividend per share, which is 5. So then it would just be 75 divided by 5, which is a PD multiple of 15. Okay, so those are the answers that I have down here. We've done the calculations, but what does that mean in terms of action? What would the firm foundationalist say? So the firm foundationalist would say a yield of 6.67. That's a buy, because remember, if we go back, that's a buy. And why do we? I just did it again. And why would we say a buy? Let me get this right. That would be a buy. And why do we say buy? Because remember, we are looking for the yield to give a buy signal from a firm foundation. We're looking for the yield to be above the historical average, which is 4.5. So 6.7 is above that, so that's a buy. Our P ratio is going to be 20, which is below 14. That's going to be a buy. And the PD multiple is going to be, actually, I forget what that number was. But I think it was below 27. Let's go back and look at it. Yes, it was. So the P ratio was 20. That was below the historical average of 14. So that's a buy. And the PD multiple was below the historical average. Sorry about that. Keeps happening. And the PD multiple was below the historical average of 27. So that's a buy. So if we were going to be a strict follower of this theory, we would give this a strong buy. It would be a strong buy signal. Okay. Now, again, we want to remember to say this is not investment advice. That doesn't mean that you should go, implement this. There's all I'm giving a very simplistic modeling of this. We can think of the P ratio. It's not the question. First of all, is how do you calculate the P ratio? There's different calculations depending on different assumptions. You could look at the P ratio during periods of high inflation, P ratio during periods of low inflation. So it's not just some straightforward thing that you just go out and apply this and you're guaranteed to make money. Okay, it's much more complicated. I'm giving you the basics, the basic introduction to these concepts. Okay, let's do one more practice problem. This is company Y. Earnings per share is $10 a share. Dividends is only 5 cents per share, so they are reinvesting most of their money. They're not paying out a very high dividend relative to their earnings. And their share price is $3. So if you want to give it a pause, calculate your yield, P ratio, PD multiple, and then decide whether it's a buy or a sell. So pause and try that, and then I'll do it. All right, so let me do these calculations. Same thing that I did above. So we're going to have our yield. I'm just going to change up my color here. Let's calculate the yield. So the yield is the dividends per share, which in this case is 5 cents per share, divided by the price per share, which is 3 times 100. And so the yield is going to be 0.05 divided by 3 times 100. The yield is going to be 1.67. So that's a relatively low yield. And so we want yields based on the previous argument, based on over here. We want the yield to be high if we're buying, low if we're selling. So this is below 4.5. So we would issue a sell signal. Okay, so on this yield, we would say that looks like a sell signal. All right, let's do the P ratio. The P ratio would be the price per share, which is 3, divided by the earnings per share, which is 10. And so the P ratio would be 3 divided by 10, which is 0.3. Now that's a very low P ratio compared to the historical average, which is 14. So if you're below 14, and this is below 14 by a lot at 0.3, that would give a buy signal. So on the yield is giving a sell signal, but the P ratio is giving a buy signal. So we're getting different recommendations here. And then finally here, let me just show all this. I'm going to calculate anyway. This P ratio is wrong, by the way. Sorry about that. It should be this 0.3 number right here. And now finally, let's do the last one. How did I get this PD multiple? So the PD multiple would be equal to the price per share, which is 3, divided by the dividend per share, which is very, very low, which is 0.05. And so we would do 3 divided by 0.05, and I get a PD multiple of 60. That's this number right here. So 60, how's that compared to the historical average? Well, if the PD is above 27, 60 is above 27. If it's above 27, then that would argue for a sell. So if we come back over here, we would give, based on the PD multiple, we would say sell. So if I look at all these together, sell, buy, sell. 2 out of 3 say sell. So I might say that this is a weak sell. I might say that this is a weak sell. Now, one last thing before I finish on this video, you might say, well, Hagen, I'm noticing that the yield and the PD multiple, these two, aren't they kind of given the same information? Because they're both just comparing the price to the dividends. Aren't they really kind of the same thing? And the short answer is yes, they are. They are very, very much kind of the same thing. And so what we're really doing here is we are really putting an emphasis on dividends. By looking at all three of these, we are really highlighting dividends because dividends is in 2 of the 3 formulas. It's in the yield and it's in the PD multiple. And we could debate whether or not we should make dividends that important. So again, all of this is open for interpretation. None of this is a guarantee to make money. There are a lot of arguments about a lot of different arguments about how one should invest. All right, either way, those are how to do some of these calculations and think about how to give buy and sell signal recommendations for companies. We'll look at more of this on some future videos. Thanks for joining me. This has been another Econ Podcast with Mr. Hagen. See you on the next podcast.